This is Hannah. Hannah wants to buy a new outfit for her avatar in her favorite online game. She's got some ETH in her crypto wallet. Unfortunately, the game's online store only accepts one particular token, DAI. Hannah has ETH, but she needs DAI. What can she do? She could use a cryptocurrency exchange to exchange her tokens, but that's pretty time consuming. She'd have to sign up for an account, send her ETH to the exchange, place a trade, or two trades if there's no direct Ethereum to DAI market, and then send her DAI back to her wallet. That's a lot of time and effort, and it's difficult for Hannah to know if she's getting a good exchange rate or paying reasonable fees. Plus, not all exchanges support every token, so Hannah might need to have more than one exchange account to move between different tokens. This is why Kyber was created. Kyber is a decentralized protocol that aims to make exchanging Ethereum tokens easy and frictionless. It acts like a universal money changer for many different Ethereum tokens. To do this, Kyber connects over 40 decentralized markets together and seeks to find the best exchange rate on the user's behalf. This means that Hannah can use any decentralized application that is powered by Kyber to conveniently swap her tokens. For example, Hannah can convert her tokens using an Ethereum wallet that has Kyber built into it. Or she could use Kyber Swap to swap tokens. Kyber Swap is a non-custodial interface for Kyber. No sign-up is required. Finally, Hannah's favorite online game could integrate Kyber directly. Instead of limiting themselves to DAI for in-game purchases, the game's developers could use Kyber to accept any Ethereum token. After receiving a payment, Kyber will automatically swap the customer's payment for DAI. This lets customers like Hannah spend the token they have while developers collect payment in the token they prefer. Today, Kyber is one of the most widely used decentralized finance protocols on the Ethereum blockchain. It can make exchanging tokens fast and simple, and that makes crypto a lot easier to use. What is KNC? KNC, or Kyber Network Crystal, is the Ethereum token that's used to govern the Kyber protocol. Every KNC holder has the right to vote on proposals to improve the protocol. Voting with KNC is simple and rewards everyone who participates. Let's take a look at how voting works. Hannah has some KNC tokens in her crypto wallet. To vote, she visits kyber.org. Next, she follows the instructions on kyber.org to stake her KNC. Staking is the process of locking up funds to participate in the protocol's governance. Staking is required if she wants to vote, but she can stake and unstake her KNC whenever she likes. After Hannah stakes her KNC, she becomes a member of the Kyber Decentralized Autonomous Organization, or Kyber DAO. As a member of the Kyber DAO, she can vote on a wide variety of topics, including proposals to improve the protocol, changes to Kyber's transaction fee, and changes to how the fees are distributed. Transaction fees are collected whenever someone uses Kyber to exchange one token for another. These fees are collected in ETH, the native token of Ethereum, and distributed to stakeholders as rewards. As an example, the Kyber DAO might vote to use some of the fees to purchase KNC and burn it, or remove it from circulation, some of the fees to reward the reserves that provide liquidity for trades on Kyber, and some of the fees to reward members of the Kyber DAO, like Hannah. The fees are distributed roughly every 2 weeks. The more KNC Hannah has staked and the more active she is in voting, the more rewards she'll receive. In addition, the more Kyber grows, the more rewards there will be for distribution. If Hannah doesn't want to vote but still wants to receive rewards, she can also delegate her voting rights to a third party who can vote on her behalf. The KNC token is a critical part of the Kyber ecosystem. It gives every holder a way to be part of the development of the Kyber protocol. By distributing rewards, it also incentivizes each token holder to actively participate in improving the protocol. C, or Kyber Network Crystal, is the Ethereum token that's used to govern the Kyber protocol. Every KNC holder has the right to vote on proposals to improve the protocol. Vote is Kyber power DeFi. Today, the world of traditional finance is highly centralized, dominated by big banks, insurance firms, and corporations. In the world of crypto, however, a different approach is gaining popularity. It's called decentralized. One, earn interest with Compound. This is Maya. She's a sophisticated crypto investor with assets on exchanges and in private wallets. However, these assets are effectively idle because she's not earning interest on any of them. Her cash savings account pays interest. Why can't her crypto? This is why Compound was created. With Compound, Maya can earn interest on her crypto assets by supplying them to the protocol. Other users can then borrow her crypto, and then they pay interest on the borrowed assets. All of the suppliers and borrowers who use Compound combine to form a series of blockchain-based interest rate markets. When Maya supplies an asset to Compound, it gets added to a global liquidity pool which other users can borrow from by providing collateral up front. When borrowers in a specific market accrue interest, the Compound protocol automatically distributes it to suppliers like Maya. This idea is already well established in the traditional finance world, where a $5.5 trillion short-term borrowing and lending industry exists in what are called money markets. Compound allows its users to participate in a decentralized money market for crypto assets, where individuals like Maya can supply their assets to Compound and immediately begin earning interest. Compound has no fixed terms, meaning that Maya can supply and borrow when she pleases, whether that's for 30 minutes or 30 years. Once a crypto asset is supplied to Compound, interest is automatically calculated and distributed with each new Ethereum block, every 15 seconds on average. This allows Maya to start earning interest on her idle crypto assets in a trustless economy that doesn't rely on a central authority to manually calculate and distribute her supply interest. But Compound wasn't just built for individuals like Maya. Because Compound is a decentralized protocol running on Ethereum, it works for everyone, anywhere in the world, and can also be integrated with all kinds of financial services and applications. Any application that holds crypto assets can integrate Compound's interest rate markets, unlocking the power of Compound interest to offer brand new features and services. Already, there's a quickly growing ecosystem of apps built on top of Compound that do this. Compound makes this possible by providing the infrastructure for developers to launch future-proof, decentralized financial services and applications that can pass down Compound's benefits to their users, enabling every user to simultaneously begin earning interest. The Compound protocol is a collection of Ethereum smart contracts, meaning it's both decentralized and completely autonomous. It allows Maya, as well as developers using Compound, to stop relying on and paying fees to third parties. That gives it a big advantage over traditional finance. Lesson number 2, borrowing crypto with Compound. Typically, in order to take out a loan, Maya would have to fill out an application with a centralized financial service provider. It's a long process with a host of requirements and opportunities for bias. To avoid this, Maya could borrow crypto assets directly from Compound instead, using assets she has supplied to the protocol as collateral. In traditional finance, this process of borrowing against supplied assets is called over-collateralized lending. Compound is different from a typical money market, though, because it's decentralized and operates completely autonomously. The only central authority is the code itself. With Compound, Maya, or any financial application or service, can instantly access borrowed crypto assets and then make use of them however they see fit. For example, Maya's goal might be to put an advanced trading strategy into place, like leveraging her borrowed crypto to invest in other assets. To borrow crypto, the first thing Maya does is supply an asset to Compound. Supplied assets immediately start generating interest and can also be used as collateral to borrow any other supported asset of Maya's choice. The more she supplies, the higher her borrowing limit increases. To limit risk across the protocol, Compound gives each asset its own unique collateral factor. This means that each supplied asset will affect the borrowing limit differently. For example, for every $1 of ETH Maya supplies, she can borrow up to 75 cents worth of USD coin. This is because ETH's collateral factor is 75%. Maya earns interest on any assets she supplies, even while they are being used as collateral. This helps to lower the cost of borrowing, as the net cost to borrow can be seen as the borrow rate minus the interest being earned on supplied assets. The interest rate for each Compound market is dynamic and based purely on supply and demand. These rates determine the interest Maya pays for borrowing an asset and are calculated per block, just like when earning interest. This is done to ensure the rates always reflect current market conditions. Over time, markets with fewer suppliers and lots of borrowers will become more expensive to borrow from and more rewarding to supply to, while markets with lots of suppliers and fewer borrowers will become cheaper to borrow from and less rewarding to supply to. In essence, the more an asset is borrowed, the higher the interest rate will rise, and vice versa. With Compound, Maya can save time and borrow crypto instantly, without having to liquidate her other crypto assets, provide her credit score, fill out an application, or wait for an underwriter's decision. Lesson number 3. What is the comp token? Compound's goal is to create a protocol that can run forever and evolve in entirely new ways. In order to achieve this goal, the protocol was decentralized by creating and distributing Compound's native Ethereum token. All changes to Compound originate from comp token holders who can propose and vote on changes to the protocol. Any user or application interacting with Compound can earn comp. The more crypto assets a participant supplies or borrows with Compound, the more comp they will earn in return. Similar to how interest is earned with Compound, comp distribution is calculated dynamically on a per-block basis and distributed to suppliers and borrowers in each market. With the release of comp, every Compound user will earn a say in the future of the Compound protocol without involving the Compound team. This is because simply holding comp tokens will allow users to vote on proposed changes and upgrades, delegate their vote to a trusted person or group to act on their behalf, and submit their own proposals for improvements to the protocol. Each proposal is executable code, meaning that there is no space for different interpretations and doesn't require a centralized team to implement. What's seen within a proposal is exactly what will get deployed if it's voted in by the community. When a proposal succeeds, it directly upgrades the protocol, allowing for new assets, revised interest rate models, and new functionality to be added over time. This puts the power of governance into the community's hands. It creates a global protocol that is upgradable and can grow alongside the ever-changing needs of its users in new and unique ways. When this video was created, about 2,880 comp was being distributed per day across all eligible markets. As market conditions evolve, so too will the allocation of distributed comp between users. The amount of interest paid by borrowers in each market affects how much comp is awarded to participants of that market. The more interest paid, the more comp is earned. While some markets will earn more comp than others, suppliers and borrowers of any specific market will always earn an equal share. 100 years from now, Compound hopes for the protocol and its interest rates to be integrated into many applications around the globe. enabling entirely new products to come to life across a wide range of industries and use cases. This will allow financial applications and end users to make use of idle crypto assets and gain instant access to borrowed funds, all while supporting the ongoing development of unique financial applications and services worldwide. Collectively, it is up to comp holders like Maya to decide the future of the protocol. With Maya's help, and with the support of Compound's community of developers and users, Compound hopes to continue to evolve over time, adding new integrations and supported assets to grow the reach and capabilities of the protocol for many years to come. Today's global financial infrastructure has a big communication problem. There are a lot of different currencies and a lot of different payment systems. Each one speaks a different language, so they have a hard time understanding each other, which makes moving money slow and expensive, and a lot gets lost in translation. Stellar's vision is to unite the world's financial infrastructure so money can flow quickly and cheaply between banks, businesses, and people. The internet connected the world's computers so information could be shared globally. Stellar is doing the same for money. To accomplish this vision and ensure integrity and neutrality, Stellar is not a bank or a business. Instead, it's a decentralized open network, supported by a nonprofit foundation that handles every currency and speaks to every payment system in its native language. That means businesses can move money globally in seconds, no matter what bank they use back home. And people all over the world can use Stellar to send money to family overseas, to convert one currency to another, or to make payments that are too small to cover fees traditionally charged by today's institutions. In the future, Stellar hopes that you won't have to use traditional infrastructure to get your money where you want it to go. Instead, you'll just use Stellar. This is Maria. She lives in the United States. And this is Maria's mom, Paulina. She lives in the Philippines. Today, Maria wants to send her mom $20. This is called a remittance. Remittances are money sent to support a family member in another country, and they're a very big deal. The World Bank estimates that global remittances are over 600 billion US dollars every year. Unfortunately for Maria, sending a remittance is pretty expensive. Her bank in the US has no connection to her mom's bank in the Philippines, so she has to use a money transfer service, which means paying a lot of fees. One popular American service charges a 3% conversion fee, and the transfer takes 3 to 4 days. The same service also offers to do the transfer faster, but for an additional fee of $9.99. If Maria used this service to send $20, it would mean half the amount would be spent on fees. That's a huge percentage. And Maria and Paulina are not alone. The average fee globally for remittances is 7.1% of the transaction. And there are millions of people who pay these fees every day. But what if Maria used Stellar? Stellar is a decentralized platform that unites banks, payment systems, and people so they can easily move money anywhere in the world. If Maria used Stellar to send her $20 to Paulina, the Stellar network would convert her US dollars to Philippine pesos in less than 5 seconds. So Paulina would receive $20 worth of her local currency, not $20 minus fees. Stellar makes this possible by connecting financial institutions to the Stellar network, which has a built-in order book that exchanges assets. So Maria could send US dollars or any other currency to her mom, and it's converted automatically to Philippine pesos. That's the vision of Stellar. Stellar is a platform that aims to connect banks, businesses, and people far more efficiently than today's financial infrastructure. Let's take a bank, a business, and a person and show you how this works. First up, the bank. This is Main Street Bank. To use the Stellar network, Main Street Bank sets up a Stellar account. Then, using Stellar's built-in tools, the bank hooks its existing infrastructure into the Stellar network. Now the bank can take its real-world assets, like dollars, euros, or pounds, and turn them into Stellar tokens. And their customers can deposit a US dollar in Main Street Bank and get a US dollar token on Stellar in return. All Stellar tokens are exchangeable. And since exchanges happen on the Stellar network, they only take a few seconds and cost a fraction of a penny. Anyone can transfer, store, and trade Stellar tokens, just like Lumens, anywhere on the Stellar network. So now the bank can take a dollar, turn it into a token, transfer it around the world in 2 to 5 seconds, and convert it back to a dollar again. For banks, Stellar makes money transfers fast, simple, and inexpensive. Next up, the business. Let's call it ABC Technologies. ABC makes an app. They want to make it possible for the app's users to buy and sell in-game items with each other using a single currency. To do that, they use Stellar to create a new token called the ABC token. The ABC token is, in effect, a new cryptocurrency running on Stellar. It isn't backed by a real-world dollar like Main Street Banks, but other than that, it acts entirely the same. With Stellar, any business can create new tokens to reward customers and create new economies and markets related to their brands. Finally, we have people. This is Lee. She's a big fan of ABC's app, and she wants to buy a new avatar. Unfortunately, she doesn't have any ABC tokens left. So what does she do? She uses Stellar's built-in marketplace to buy some. Lee has US dollar tokens that she previously bought from Main Street Bank. She transfers those into the ABC app and instantly converts them into ABC tokens to buy her favorite avatar. And if she has some US dollar tokens left over, she can return them to Main Street Bank and get her dollars back right in her bank account. Or she can hang on to them or trade them for another token. Any asset can be turned into a token on Stellar. Traditional currencies, cryptocurrencies, real estate investments. So whether you're a bank, a business, or a person, Stellar makes it possible to quickly and efficiently issue, exchange, and transfer tokens in an entirely new way. Stellar is a platform that connects payment systems and people. It's a decentralized network, meaning no single company has the power to turn it off. Stellar's decentralized network is made up of all the independent computers that run Stellar software. Anyone can join. Stellar's network is different from Bitcoin's in a few key ways. Computers on Bitcoin's network compete with each other to validate transactions through a process called mining. This requires expensive hardware and lots of electricity. Stellar doesn't rely on mining because when a network's miners disagree, the network can split in two. This has happened in the past with both Bitcoin and Ethereum. But because Stellar allows digital versions of real-world assets like digital UN or digital bonds, Stellar had to devise a way to prevent the creation of duplicate versions of those assets. For example, if a dollar on Stellar were duplicated, its backing bank would suddenly owe 2 real-world dollars, one for each copy of the network. This would obviously be a problem. So Stellar uses a unique way to settle transactions developed by researchers at Stanford University. Here's how it works. Stellar relies on cooperation within the network, rather than competition. Each company doing business on Stellar connects a computer to the Stellar network. It picks a few other computers it always wants to agree with, it processes the transactions they process, and keeps its list of transactions aligned with theirs. The computers the company depends on, in turn, have chosen to agree with others, and those ones agree with still other computers, and eventually the whole network is covered in an interlocking web of agreement. It's actually very similar to how the Internet's web servers work. Stellar uses this pattern to guarantee the network's safety. Every 5 seconds, the connected computers negotiate with each other according to very specific rules to finalize their agreement. They cross-check each other across the whole network, all at once. The rules of the system have been designed so that even if bad computers participate, accuracy and stability are maintained. This agreement system is called the Stellar Consensus Protocol. It allows computers running Stellar to process transactions in under 5 seconds without using a significant amount of electricity and for a very, very small transaction fee. So who runs Stellar nodes today? Global banks, developers, businesses, anyone who wants to transfer money via the Stellar network. Stellar is simple to set up, free to use, and above all, it's open to everyone. And that's a big improvement over today's international financial infrastructure.